Good afternoon, everyone. This is Antonio Rodriguez. I'm a partner, portfolio manager here at Procyon. Thank you for joining us for this webinar today. Sorry, we're a couple of minutes late. Apologize. Today's day and age, as you know, technical difficulties do arise. Is the corona way, as we say. Certainly, it's sort of apropos for today's webinar in terms of behaviors and how some of our emotions can run high during turbulent times. When things that arise that we don't expect can happen, our plans can be sort of foiled, and what's important about that. And so we thought it would be great to include you in our conversation. So we hope that this, we're not going to take too much of your time, but we hope that this comes off as informative to you. And so we've invited a couple of people to join us. We have Mark Peterson from BlackRock. I'll let Mark introduce himself. We also have Carolyn Wetzel. She's a private wealth advisor here in CFP. And so Mark, if you don't mind, why don't you take the floor and introduce yourself?
Great, thanks, Antonio. Good afternoon, everybody. Thanks for having me on your call. My name is Mark Peterson. I'm the Director of Investment Strategy and Education here at BlackRock. And I'm a 25-plus year veteran, been with BlackRock for a little bit over 9 years. And we do a lot of work on this type of topic. We call it psychology of investing, but something that we think is extremely important, especially in a year like this. Probably, in I think looking back, we'll say this has obviously been a tremendously challenging year, but probably one of the most challenging for investors, just psychologically, between the virus and the health concerns, the shutdown and the economic concerns, the market volatility back in March. Then you throw a really divided election on top of it. I think it's a perfect time to talk about this topic.
Yeah, no, that's a good point. We're really happy that you're joining us from a firm like BlackRock. You guys are one of the mammoths in the industry, $7.5 trillion in assets under management. Procyon's proud to have you here and proud to get some of the thought leadership that you're going to be able to provide. Also, Carolyn, why don't you take a minute and introduce yourself?
Thanks, Antonio, and good afternoon, everyone. It's such a pleasure to be with you today. As Antonio mentioned, I am a certified financial planner and am pleased to be a Vice President Private Wealth Advisor with Procyon. I've worked in financial services for just over 20 years, specializing in financial planning for the last 5 in particular. And what I love to offer clients is peace of mind when it comes to their finances, which is why today's topic is so important to me too.
Yeah, no, that's great. Peace of mind is really a lot of what we want to provide to our clients. I think that, one of the biggest things I'll say to clients is, listen, if you can't sleep at night, that's a problem. We need to make sure that we're doing all the right things to get you through your daily life so that you can focus on the things that are important. And, that's really what confidence is focusing your behaviors on what's important in your emotions. And so at this point in time, I think, going through the COVID-19 pandemic, things have shifted. Ideals have shifted, thoughts have shifted, points of view have shifted. Money has shifted around the world. The markets did what they had to do. I think we all know that we're shoulder deep, in this thing. And it's one of the worst or hardest things we've had to face in human history. So we should know that our behaviors coming out of this may be influenced by what we were exposed to. A lot of people would sort of categorize that even as trauma. And so when we're coming out of this with that level perhaps of trauma or that level of emotion, what's our new expectations? What should we be thinking about as we move forward? Mark, I wonder if you can put any color to that. I think we all deal with this on a daily basis when it comes to individual clients. We work hard to make sure that we're doing it the right way. But in terms of managing expectations coming out of this, what are you thinking, Mark, and what are you seeing out there?
Yeah, no, I think it's a great place to start when you think about expectations. Setting expectations for the portfolio, for the investment plan, I think is critical. Oftentimes what we see with investors across the country is if you don't set those expectations properly, the emotions that get revved up on both sides, it could be both on the positive side, what we call envy, and the other side on the loss side, tend to be more pronounced and more of a problem if those expectations aren't set properly. So we'll talk a lot about those two extreme emotions. We call it envy and loss. That's really where we see most of the mistakes made. And as I mentioned, that expectation setting is really critical there. One of the the studies, and this has nothing to do with the financial markets, but it's a great study looking at just the expectations, or at least the perspective of folks as Olympic medal winners and their happiness on the podium. I don't know if you've ever seen this study, but it's one that we use quite a bit when thinking about, especially on the envy side, the challenges that folks can face depending on the way they view certain situations. And certainly that ties back into expectations. And the study, and they've done these studies for years around the Olympics, and they look at the happiness of the medal winners on the podium. Believe it or not, somebody actually studies the happiness of medal winners on the podium. And the fascinating thing is they always find that the bronze medal winner is almost twice as happy as the silver medalist. Of course, the gold medal winner is the happiest. We throw them off the study because that's not as interesting. But think about the perspective of that bronze medal winner, right? They're just happy to be on the podium. I don't know what you get for fourth place in the Olympics, but I know it's not a medal, and I know it's not being on the podium or getting your flag or your country's flag raised in your honor. So tremendous drop off, and you see that happy to be there emotion come out with that bronze medal winner. Whereas the silver medalist, think of the silver medalist perspective. They probably just missed out on their lifelong dream of winning a gold medal in the Olympics, right? In some of these sports, it can be fraction of inches, fraction of seconds, and they just missed out. And that dominates their experience, and that's their perspective on the podium, and it can really taint your experience. And for us, that's the type of emotions that can come out if your expectations are not set properly, both to the good and the bad side, right? And we'll talk more about loss emotion as we go here today.
And I think that, also it's a fair way to kind of say a couple things. Number one is everyone's expectations aren't exactly the same as each other, even if you look the same, number one. And number two, making sure that the expectations are set so that they're achievable, but challenge you as well. And I think, come rising to the challenge. And I was also thinking as you were talking, nowadays with HDTV, we all study the happiness of the medal winners at the Olympics. But it's true. Context is the other piece. And so, Carolyn, if you don't mind, in terms of private wealth, your job really is to provide context in terms of expectations. And I wonder if you can talk a little bit about how you're able to do that.
So well put, Antonio. And if we're honest, if we acknowledge the reality, the majority of clients that we work with are already enjoying a solid financial foundation. By way of example, the majority of them have a few $1 million of assets under advisement, and they're looking for something a little bit more than just returns. So one of the first things that we emphasize doing with clients is just asking questions. What's important to you? What is it that you're trying to do with your wealth today and over time? What are the kind of emotions that you feel? What do you like? What do you not like? What do you want to do differently? After uncovering the current client's relationship with money, the second thing we enjoy doing as part of managing expectations is to manage wherever they are today in their journey with information. If they're fearful about losing it, how do we manage it with statistic and guidance and perspective around how to cover for that? If they're anxious about new opportunities, let's come up with a plan for managing that anxiety accordingly. And lastly, after acknowledging the emotion, after managing it with information, the key and most critical element then is continuing to monitor the experience. As we develop a plan for the way forward, we want to be accessible, we want to be relevant, and we want to be continuously monitoring. A, how are we doing together on your finances? And B, how are you continuing to feel in the process? Because the truth of the matter is that there will inevitably be highs, there will inevitably be lows, and the sooner we can acknowledge that, call it out, and plan for it, the better positioned we are to manage surprises along the way. And I think immediately of a wonderful client vignette or perspective. As I first began the privilege of working with a very accomplished medical doctor who for the first time was responsible for her finances due to the death of a loved one, she asked me in no uncertain terms, she said, "The one thing I ask of you, Carolyn, is to be the advisor to me in the same way that I am the physician to my patients. I want you to manage me and my expectations. Help me navigate the future." And it's in that spirit that I aspire to manage other clients' expectations every day.
Yeah, and I think we should all realize that what you're saying is really true in daily life. All of our expectations are managed at some point during the day, whether it be the line at the grocery store or whether it be, the expectation for the distribution of a vaccine. All these kinds of things are really built up in our minds. And when it comes to finances, you've got to have some personal confidence in your own context to be able to deliver sort of on that roadmap.
Yeah.
And speaking of sort of a roadmap, if you have a map, a lot of the worry kind of goes away, right? You know where you're going and where you're headed and how you're going to get there. And, in our world, we call that asset allocation, what goes where and how much and for how long, right? So how do I invest in during these markets and where should I put it for my goals? And so I think there's lots of different ways that this has been looked at over time. It's been studied. Modern portfolio theory studies asset allocation in depth. We all follow a lot of that in the industry. But I think, the roadmap is the asset allocation. And Carolyn, since there's context in each client we're dealing with, talk a little bit about, that roadmap and how that asset allocation starts to form over the course of you getting to know a new client and really helping them throughout their lives.
Sure.
Especially as it relates to right now and sort of this up and down period that we've experienced.
I hear you 100%, Antonio. And I think the greatest value, according to what clients have said with regard to asset allocation, what they appreciate that we do is we translate the science and the art of investing into personal terms. So said differently, what I love to do when talking about asset allocation and how people should be invested is I pivot and I say instead, what kind of expenses do you anticipate having in the future? Or said differently, what do you want to do with your money? Secondarily, when? And thirdly, if between now and then, the value of your money may change. So you could at any point in time log into your account and see a few more or a few less zeros in your account. How are you going to feel? And once we have those initial conversations and make it personal, then we can then apply the science and the art of investing and filtering the universe of different investment solutions so that in combination, they will grow and be accessible to those clients over time. We consider as a result, those personal questions enable us from investment professional perspective to identify and quantify risk. From an investment professional to say, what is the exposure and what are the vulnerabilities and what are the trade-offs around different solutions? And along the way, as an advisor to the client in terms of asset allocation to ensure you're able to sleep peacefully at night. And I think the greatest example of how that works in the care we try to provide clients in defining the right asset allocation for them was evidenced in March of this year. As you know, Antonio, together we take a great amount of time with clients to try to quantify as best we can how comfortable they are with what they're doing and why. And we take great time to also say, if, and this is pre-March, if 2007 to 2009 would happen again, and the value of your assets would go down by 25%. Now in December 2020, we change that to more than 30% as evidenced in March of this year. How would you feel? And I think one of the greatest testaments to that rigor and the care around asset allocation came back when in the short hours after that dip happened, and I was calling clients, they said to me, Carolyn, don't get me wrong, I don't want to lose money, but this is what you talk to us about. So this is the key takeaway, Antonio, I'd love to emphasize, that there is a science and an art to managing that combination of exposures. And the way it becomes real for private clients is then identifying for them, when do they want to use that money, how, and how will they feel comfortable in a way, and managing it accordingly along the process.
Yeah, no, and I think that's true. And it can become complicated, obviously, but, Mark, BlackRock's got, $7.5 trillion in assets. Asset allocation is a huge theme. They're a big part of that around the world. And so, I imagine, and I know that, asset allocation isn't one size fits all, and it does need to be contextualized in terms of helping people get through and battle those behaviors that can, as humans can sort of make some mistakes. And so I wonder if you might help give us some color on where you come in on asset allocation and how you're sort of helping to deal with that.
Yeah, no, absolutely. I really like the art and science mix. I think that's a good way to think about it. And something we see that's consistent across the country, even some of the best investors we work with, is that a lot of times the diversification, the portfolio, the asset allocation, the benefit is hard to see, right? Because of these emotions that we see at various points of the cycle. We see the loss emotion come up, as Caroline said, you still lose money when the market goes down, right? And then you don't make as much when the bull market returns. And when you start seeing that in a short-term way start to play out, you feel like the silver medalist, really, you do, that we touched on earlier, where there's always something a little bit better, right? There's always something a click higher in your portfolio on either side. So we often see that with a diversified portfolio. It's just tough to connect the dots on why it makes sense over time. And we have a slide on it. I don't know if we have the ability to pull up the slide, but if we look at the last 20 years, probably no better example than the emotional challenges that a diversified portfolio has. Looking the last 20 years, because think of where we've been the last 20 years. We've had a tech bubble burst. We've had a financial crisis. We had the longest economic expansion in history, and then you throw a global pandemic on it. So it's been an incredibly volatile period. And this slide, hopefully everybody can see this slide on the screen, really highlights that. And I tried to capture it with my fancy emojis here on the right, but you get this dynamic that we touched on, just how emotionally challenging it can be, where you still lose money in a challenging market. Look at 2008, right? One of the worst years ever for a diversified portfolio. In this case, we're actually looking at a 60-40 stock and bond portfolio. I know everybody will have a little different allocation based on where they're at in their investing life cycle. But 24% in one calendar year is one of the worst years ever for a diversified portfolio in the history of investing. That never feels good. You can't hide that on a statement anywhere, right? That obviously will capture that loss emotion, never feels good. But then look at the other side. Look at that 11-year period from 2009 to 2019. You didn't make as much. U.S. stocks were up over 350%, yet the diversified portfolio was only up 190. You didn't make as much, and it's amazing how many folks we had. Again, even some of the best investors we work with across the country that were feeling like they left too much money on the table, right? That they didn't get enough of that upside, and that envy emotion was rampant. We actually gave it a name. We called it S&P envy, which you see at the top of the slide. So prevalent in that type of period because folks are seeing that the diversified portfolio trailed. And then, of course, we layered in the first quarter of this year, you can see. But look at the bottom. Look at the 20-year period that this entire stretch represents. The diversified portfolio actually ended up ahead here, actually outpaced U.S. stocks. And not to mention, it did so with a lot less risk, a lot less drawdown, a lot less volatility. That's really the punchline here, that I think a lot of folks, when you look at asset allocation, diversification in small time periods, you lose this because you get caught up in the emotions of the period, whether it's losing money on the downside or not making as much. You start to rinse and repeat that over various cycles. It's tough to connect those dots emotionally. And that's what we like to try to do with our folks, is really take that step back. This 20-year period, probably no better period in history than showing that example on why we build portfolios the way we do, why we asset allocate and diversify and spread your investment eggs across a variety of investment baskets. It's really to get what we call at BlackRock, winning more by losing less. Winning more by losing less is really what we looked at on that slide. And it's really what asset allocation, diversification, and why we build portfolios the way we do.
Yeah, no, I think it's a good point. And the truth is, if we all knew what to buy and what to sell in every single day, then there would be no emotion, and we wouldn't need to be diversified, and it would all be quite easy. But we know it isn't. And so that's a really great illustration of the difference between what you think is going on in the portfolio and what may actually be going on over long periods of time. So I'm glad that was terrific. Good capture there. Now, we've got, we set our expectations, we contextualize, we set a roadmap, we've got all the asset allocation correct, we've got 60% here and 40% there, and we own all kinds of things. We own growth stocks and value stocks, and some pay dividends and so forth. And that's great. And that's moving along. And what happens though, when that's going along and you're cruising and all of a sudden COVID-19 hits? fear of loss. It happens to all of us. I've worked with some very complex organizations over the course of my 20-year career and continue to do so. But I've also worked with some non-sophisticated investors because that's just the way that we do things. And so ultimately, I think what happens is fear happens to anyone. It doesn't matter if it's a sophisticated organization made up of humans or it's not, or if it's just an individual. And so fear of loss is a very real thing. And so I want to just get Mark's sort of along those lines. I just wanted to kind of get Mark's take on fear of loss a little bit and what that may mean to you. Is that fear sort of misplaced? Where's the fear correctly sort of should be focused? And I wonder if you can talk a little bit about that for us, Mark.
Yeah, this is the loss emotion that we touched on earlier. It's probably one of the most studied parts of behavior, what they call behavioral finance, which is kind of the psychology of investing, understanding how folks' emotions might affect their investing decisions. And that loss emotion, one of the pillars of the academic work is that losses feel twice as bad as gains feel good. So think about that for a minute. Losses feel more than twice as bad as gains feel good. So losses can really make folks do irrational things. And you see that, especially in the first quarter of this year was a great example of it, where folks will do the wrong thing, right? Or they'll do something at the wrong time. And we certainly saw that in the first quarter. I think there was a study that showed a third of retirees that actually sold some portion of their stock positions in March, April, or May, right? Think about all of the rally they missed out. And it was all because this loss emotion gets revved up, right? And the loss emotion gets revved up. One of the biggest things that we've seen is that folks, when they get this loss emotion revved up, they want to do something, right? It's known in the behavioral world as a tendency towards action, is that whenever we see something is wrong or is challenged, not working, we have to take action to fix it, right? And in most aspects of our life, that's true, right? If the car's not working, you have to take it into the shop to get it fixed. It's not going to fix itself. But that also can be challenging within a portfolio investing setting. Because think about, what do folks normally do if they do something with their portfolio in a period of loss? They'll want to get out of the market, right? They'll want to time the market, as it's known. And I'm sure we've all heard the old stock market adage, it's time in the market, not trying to time the market. That's all that loss emotion and that tendency towards action wrapped up into one. And this year is probably no better example of that than what we touched on earlier, is folks, right? They just want to miss the worst days in the market. The challenge, though, historically, is the best and worst days in stock market history sit right on top of each other. They all live in the same neighborhood. And we saw that earlier this year. We had 3 of the worst trading days in stock market history in March. Actually, 3 of the worst 15 days since 1950 in March. But we also had 5 of the best 15 days since 1950 in March. So think about that. 3 of the worst, 5 of the best. The challenge, of course, is if you are one of those folks that got out of the market after one of those bad days, you most likely miss some of those best days on the other side. And it's amazing how big of an impact that can have on your outcome, missing some of those best days in stock market history. So I think it's important to understand how all these things are intertwined with our emotions, right? That loss emotion gets revved up, the tendency towards action kicks in. When that does in your investing life, oftentimes that can give you the temptation to try to time the market. But we need to understand that that most likely will lead to missing some of those best days in market history on the other side. So that's one of the biggest challenges we've seen this year. It's not just this year, though. It always happens when the market gets volatile. I think it's really important to understand how all those things are connected together.
No, I think that's well said, Mark. We often wonder, if you got a stock tip from your neighbor, who's tripling every other day, you wonder if that's really happening, and you start to get this fear of missing out, right? You sort of want to start to trade and get in on this stuff. And so you sort of waffle between fear of loss, which these are assets you've likely worked your life for, have likely sacrificed for, and are likely not willing to see them go backwards. And so you start to think about all those things and the push-pull. And so on a regular basis, it's really important for us to make sure that clients' fear of loss is not directed at just what happens tomorrow. And so, Carolyn, that's obviously a large part of what you're doing on a daily basis and will continue to do. I wonder if you might shine a little bit of light for us, as of what's going on recently. How has some of the fear that has occurred influenced behaviors, and how are you helping people through that?
Thanks, Antonio. I love to frame this really as layers of protection we love to offer clients. And what do I mean by that? I'd say the first layer of protection we love to offer clients as they're managing those fears of loss is first having a safe space with us to say, hey, Carolyn, I'm seeing what's happening and I just want to talk. Or, hey, Antonio, my neighbor is claiming all this. What do you think? Is this legit? Is this, or is he full of it? Like, what is this all about? So the first thing we like to do is give clients a space and the access to say, what do you think? And then secondarily, as they share with us what they're thinking, to then provide some constructive and informed opinion around what they're saying and how it fits in light of their existing situation today. So to follow that same example, hey, I hear you're concerned about this in this moment. Let's talk through the existing steps we're already taking to protect you, including by way of example, whatever is most applicable, your financial plan, or this combination of diversification in your investments, or you are open to more risk, and that's why we're doing this in this situation. And use that second layer of protection, reminding the client what we're doing in this moment to best protect them. And in light of that, whether any fine tuning is appropriate or is not. And that's where it's this second layer of protection I love to advise people on, that sometimes, as you pointed out earlier, Mark, the best value that advisors can offer clients is sometimes saying, I hear your emotion, and even with that, no action is most appropriate right now, and here's why. And the third level of protection that we offer, and this is why I'm so proud to be part of Procyon, is a structured yet flexible investment process. You see, the majority of clients who work with us from a private client perspective benefit from multiple layers. Their dedicated financial advisor, and in addition to the advisor, dedicated portfolio managers who create their investment strategy, and the additional layer of the formal investment committee, comprised of advisors with all different levels of expertise, analyzing the macro environment, looking at the economic trends, looking at geopolitical considerations, and being nimble and flexible enough to have a structure that can adjust like we did earlier this year. And as you say, Mark, to be available and ready to benefit from those 5 days of great upside over the long term. So really, to synthesize, because I'm clearly passionate about all this stuff, the way we love to provide clients that safe space to manage those fear of losses: first, give space to talk about it. Secondly, provide clarity, again, what are we doing already and how have we planned for these times, and where necessary, if necessary, fine tune that. And lastly, benefit from a team of professionals who have a structured way of looking at the investment universe and adjusting that universe as and when it makes sense as market needs change.
Thanks, Carolyn. It's important to note that you're describing a lot of things that we're doing and that are extraordinarily important. And the pandemic, I think a lot of what we should come out of this is that human behaviors and emotions are the same as they've been. Anger, confidence, confusion, happiness, those sort of come and go over periods of time. And our behaviors our behaviors will also sort of do the same kind of thing. But when it comes to adding layers of protection, as you describe it, Caroline, what that does is that allows these emotional biases to work themselves out with a team of people. And so during the pandemic, it's great to be able to sort of bounce ideas and talk to a team of people. And I think that's important for mental health as well. And I think that kind of goes to the last point here. We only got a couple minutes left, and then we'll give everyone back the rest of their lunchtime. But in terms of really an advisor's role as a coach, it came into huge play well, I've been doing this for over 20 years, and I started in this business as an advisor in 1999, and I've been doing it since then. And there have been a couple of periods of time that were extreme during that time. You had the dot-com bubble, you had 9/11, you had the recession, then you had financial crisis, and now you had the pandemic. And there are extreme times when emotions run high, and as advisors, we're not completely immune to it. So we have a group here, a group of people here that can help each other through those things as we are humans, so that we can help clients go through the layers of protection without really getting too caught up. So our role as a coach isn't just on a one-to-one basis, but it's certainly as a firm. And I think that's important to kind of put out there. Carolyn, maybe describe a little bit about that, if you don't mind, and then we'll have Mark kind of close it out a little bit with some thoughts on coaching. Go right ahead. Thanks, Carolyn.
Sure. And I love in this moment how we're using the word coaching, because I think that best encapsulates the type of relationship we love creating with our clients. In the same way, perhaps many of us played sports and there was a trusted, experienced individual or team of coaches who helped us understand the mechanics, who challenge us constructively along the way as we strive to refine the art of whatever sport we were part of, and supported us as we were successful. And when things were tough, provided us points and a shoulder to cry in, and then keep going, keep going. It's that spirit that we like to offer our own clients. And what I love to say in particular is what that relationship looks like is listening. What is it that's important to you with an intention to understand? Secondarily, to share with you our specialized perspectives so that you can make thoughtful decisions along the way. And thirdly, and most importantly, being by your side, as whatever new game you're playing today, you can count on us to be right there. And I'll never forget, there was one particular couple that when I was first beginning to work with them, and they described the type of advisor that they wanted to work with in the future. And to summarize this very articulate client, he said, Carolyn, I don't need you to be clairvoyant when it comes to the markets. I need you to listen to me, and I want you to be by my side. And it's that kind of coaching, collaboration relationship we aspire to deliver on every single day here at Procyon.
Thank you. And Mark, working at being a director there at BlackRock, having years of experience in the business and being a wealth of knowledge, I'm sure you're talking with advisors on a regular basis. If you don't mind, just a minute or two on advisors as a coach and some things that you're seeing out there that may be helpful.
Yeah, no, absolutely. I don't think we talk about this enough as an industry, honestly. It is that critical piece. And Warren Buffett famously said, we don't have to be smarter than the rest. We just have to be more disciplined than the rest. That's really the key to successful investing. And you think about it, that discipline's all around controlling emotions, right? And that's what a coach does. And that's why we think this piece is just so vital to help build in that discipline. I think both through education and also being that check and balance over time, right? No better way to build in discipline than to educate, so you have that foundation of knowledge, but also have a check and balance to make sure you're not stepping into bad habits. Actually, this is something at BlackRock that we're so passionate about. Even our best investors here at BlackRock, some of the folks that run our mutual funds, they actually have behavioral coaches that work with them. Even though they're experienced investors, some of the best and brightest we have at BlackRock, they actually work with an emotional coach to make sure that they're not falling into any of those traps as well. Granted, they tend to be, as experienced investors, they tend to be very different traps than less experienced investors, but it's the same idea here that we're trying to really capture. Because really, at the end of the day, it's all about performance. If you do the wrong thing, you let your emotions get the best of you, you do the wrong thing, like we talked about, right? Missing some of those best days in market history on the other side, that all ends up impacting performance. And that's what we're trying to really maximize at BlackRock, not try to lose out on some of that investor return that gets lost when you let your emotions get the best of you. So no better way when you're trying to break bad habits than have a coach there with you to be that check and balance. So for us, again, I think it's one of the biggest things that we don't talk enough about as an industry, and I'm glad you guys are really hitting on it today.
Yeah, no, we appreciate that sentiment, Mark. We completely agree. There's all walks of life could use a coach. Certainly everything from the most sophisticated, highly educated investment person who may need a coach to all the way down to someone who's focused on something completely different. And so we are keen to that, and we thank you for that. And we think through this period of time, we hope that we've been able to deliver for our clients some good coaching and some good partnerships. And so with that, we're going to close this out. Thank you all for joining us for this edition of Procyon Perspectives. Thank you, Mark Peterson from BlackRock. Thank you, Carolyn. I'm Antonio Rodriguez. And we hope you stay well, stay healthy, and have a great holiday season.
Thanks, everybody.
Thank you.